Hi, and welcome to our end of February update from the Wealthy Doctor Institute, physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with their current investing strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those of you who are new to the concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month, we'll update the life of a busy doctor, then we'll talk about the topic of the month, then we'll review our system, starting with our 20-month moving average system, our MRI system, the rules for the 25% stop loss system for when you really want to have to buy individual stocks. And then we'll monitor the free sector server strategy that comes with your sector server subscription. So, day in the life of a busy doctor. Now, even though I semi-retired 5 years ago now, life continues to be busy. Again, for my colleagues who practice in academia or private practice, running a business from scratch requires a whole new skill set, one that I'm still learning to this day. So I still travel. In fact, last month I traveled to California to update myself on different technologies where I can help reach out more to people like you, and then went on to Florida, where for the beginning of the year, it's critically important to map out a plan for the rest of the year. And of course, life continues to be busy at the hospital. But despite the busyness, I still easily place trades indicated by my systems. They literally require mere minutes to see and execute. So the topic of the month is whatever gets measured gets managed. Now, what do I mean by this? Well, if you take a look at when people try to lose weight, people who tend to weigh themselves regularly on a scale, maybe once a day, once a week, tend to be more successful rather than people who weigh themselves maybe once a month or once a year, if at all. And as physicians, we monitor various parameters whenever we are trying to manage conditions, such as, for instance, blood pressure when trying to control hypertension, bleeding times, tumor markers, thyroglobulin levels. Whatever it is that we're trying to manage, we need to measure. And the same goes for our personal finances. It's not just for corporations. And if you think that those corporate financial documents that are published for these big corporations is all they need, you better believe these corporations monitor their finances a lot more closely. Go to any casino. Guess how often they monitor the financials of any of these blackjack tables. It's not once per day, it's once per hour. So let me give you an example of what I mean by measuring our personal finances. Here's an example from when I was a broke intern. Back then, I heard Tony Robbins say that we often overestimate what we can do in 1 year, but underestimate what we can do in 10 years. So at that time, I was near broke, but I was dreaming big. And I was dreaming, gee, what would happen in 10 years if I could think of some big audacious goal that really made me sweat and squirm and really doubt I could really reach it in 10 years. So I overestimated what I thought I could do in 10 years. And then between this dot 10 years from now and this dot where I was in intern year, I calculated out the trajectory which I would need to follow in order to reach my goal. And then what happened after that was every week I would add up all my investing accounts, my checking accounts, my credit card debt, everything I owned, and I would plot it week by week until finally you can see this pattern. So for years, I was actually on track. I was very proud of myself. And then, of course, 2000 hit. I didn't lose that much, but I didn't really gain much for a few years as well after that. But because I was monitoring myself every week, I was able to make corrections on whatever it is I was doing in terms of investing or savings plan, and eventually I did finally reach my goal 2 years later than I forecasted, but holy cow, I actually reached my goal. That's the power of setting a goal and monitoring it. So here's another example from a more recent book from Tony Robbins, trying to figure out what kind of goal we need to set. So for instance, we've reviewed this before, but let's review again. Right now, when we're trying to trade time for money, we need to save a certain amount and invest to grow to a certain critical capital mass so that the income earned by this critical capital mass can replace our income for life. So the question always is, how big does this critical capital mass have to be? Well, if we think about learning to shoot at a target, and you can talk about bows and arrows or guns or whatever it is, in this political climate, I won't say guns, but if you want to shoot target, you shoot for something that's close by first. Let's say 10 feet away. If you can hit that target 10 feet away, then you move the target back 100 feet away and see if you can hit that. And then maybe 1,000 feet away. Well, here we have the various levels of financial security, vitality, independence, financial freedom, and absolute financial freedom that we can try aiming for. And here's how we would define them. For financial security, all we're looking at are 5 factors: housing, utilities, transportation, food, and insurance. If you can figure out how much you pay per year for this and multiply that by 25, it is very feasible that a fund that size would be able to take care of these 5 different expenses for the rest of your life. Now, nothing's guaranteed. It depends on how you manage that fund, but at least that's a target. Once you reach that financial security target, then you can add in clothing, dining, entertainment expenses for financial vitality, financial independence, finally put in 2 or 3 significant luxuries for financial freedom. Then for those of us who are driven enough or lucky enough, however you want to take a look at it, get to the absolute financial freedom stage, more power to you. But most of us, I suspect, are still working on financial security. So here's how we calculate it out. Just these 5 things. If you have a monthly figure, just plug in the monthly figures, add them all up, multiply by 12, that's your yearly figure. Take that yearly figure, multiply by 25, that's the critical capital mass for your financial security. So this is what I do with my clients now. I have them figure out where their financial security, vitality, independence, and freedom targets are, and then I plot out these trajectories to reach all these various levels. And then, rather than just meeting with them quarterly, I have them engage in their own financial salvation. In other words, I have them every week add up again all the assets, all the liabilities, add them together, plot it on a graph, and see where they lie along these trajectories. Whatever gets measured gets managed. And it's not just for financial growth. Here's an example I used for when I first got a mortgage. Here are the bars representing how much principal I had left in the mortgage. And these smaller bars are cumulative interest I've been paying on the loan so far. And if you know mortgages, they front load all their interest in the front. So if you don't want to pay interest, you better pay off the mortgage fast. Although in another video, I try to show you how sometimes you don't have to pay off the mortgage that quickly if you want to optimize your financial growth. And I'll get into that more in another video. But again, this is just another example of how monitoring something increases the chances of success, in this case, quenching my mortgage debt. So now let's review our systems. We'll start off with the 20-month simple moving average system, abbreviated the 20-month SMA. The rules of this system are simple. If the S&P 500 index fund is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. Remember, the 20-month moving average is our safety belt. It only works if we watch it every month. So here's a graphical interpretation of what's going on. The blue line is the S&P 500 index mutual fund, dividend corrected. The red line is the 20-month moving average. Now, several people have commented in the beginning of February we did crash a little bit. And I had emails and people asking me, why haven't we gone out of stocks yet? But, it never met criteria to get out. And in fact, if anything, stock markets went down and then went back up again. And if you take a look at grand scheme of things, that dip we had in February barely registered on this long-term graph. So how do the numbers go? The VFINX, which is the Vanguard S&P 500 Index Mutual Fund, closed with a price of 251.27. The moving average went up to 220.58. So the price went down, the moving average still went up, and that's because the average price is still higher than the moving average. So if you do a little basic math, divide, you get a 14% cushion right now. In other words, the S&P 500 index can drop up to 13.9% and we'd still be considered in a safe zone if it doesn't drop more than that by the end of next month. So right now, we're still in relative safe territory. But again, watch this once a month. Not more often, not less often. So the observations for this month, the 20-month moving average continues to signal relative safety in the U.S. stock market. Although the index fell in February, it remained high enough to remain in the safety zone. However, the safety cushion is decreasing. It used to be 20%, now it's 14%. Now remember, this system is not designed to catch peaks. Markets must fall enough to meet criteria for danger zone before we get out. No system is perfect. No system can prevent us from suffering some kind of loss. Remember, this is just trying to prevent us from suffering the larger multi-month to multi-year bear market losses, not necessarily the individual daytime or monthly variations. So here's Sector Surfer's StormGuard Armor example using the exact same stock and bond mutual fund. Sector Surfer says, yes, we are still in the stock fund, not in the bond fund. And here's the StormGuard Armor indicator. So it's still positive. It is decreasing, but it hasn't yet met criteria to get out of the stock market yet. So our next system is the Monthly Rotation Investment System, abbreviated to MRI. The rules of this system are simple. We only have 3 funds to monitor: the S&P 500 Index Mutual Fund, the Emerging Markets Mutual Fund, and the Inverse S&P 500 Index Fund. Remember, every month we rank these 3 funds, sell the bottom 25% of our portfolio, and use those funds to buy the top mutual fund. And if you have access to ETFs, go ahead and use ETFs. They're easier to trade, lower cost. So here's a graphical example of what we're doing with the MRI investing system. Last month data, this month data. Divide, and we see that the S&P 500 index fell 3.7%. The emerging markets fell 4.7%. The inverse S&P 500 index gained 3.4%. It was a struggle. Initially, the inverse fund did go up, but then it started to drift down before going up again. Just a mirror image of what the US and the emerging markets funds did. So this month we have a clear winner. And this is what we do with the clear winner. Last month we were 100% in the emerging markets fund. We can sell 25% of our portfolio and use it to buy the top fund, in this case the inverse fund. So now we're 25% inverse fund, 75% emerging markets fund. And here's the Sector Surfer rotation version of the 3 funds. So the VFINX, the emerging markets, the inverse fund. Right now, Sector Surfer says we are still in the emerging markets. Remember, these are 2 different ways of rotating these 3 funds. Whichever one you're following, stick to it. Don't mix up the systems. So the observations for this month. The markets initially sold off. Both the US large cap stocks and the emerging markets sold off approximately the same percentage. And then right now the inverse fund is a clear winner for now. Sector Surfer, meanwhile, continues to be in the emerging markets. Remember, the SMA strategy and the Sector Surfer strategies are completely different. They use different rules, different criteria, same funds. Don't mix up the systems. Our next system that we'll be reviewing is a 25% trailing stop loss system. This is a system where if you really want to buy an individual stock and not a fund or an ETF, limit risk to just 1% of your portfolio or trading account. Remember, individual stocks have idiosyncratic risk in addition to systemic risk. In other words, if you have overnight news, something bad about the stock, and the stock next day tanks, even if the rest of the sector is doing well, you got killed with this one stock. So we can somehow manage to limit the amount of damage any one stock can do to our portfolios to just 1%. That's one way of risk mitigating. So, given the 1% risk, we want to use only 4% of the trading account to buy that one stock, and then immediately put a 25% trailing stop loss order. In other words, whatever price the stock is, if it drops 25%, it automatically sells the stock. So if the stock goes up 33%, if it drops 25%, it's back to break even, and the stop loss has also gone up to break even, and that's when we would get out. So using that knowledge, we know that if the stock goes up 33%, the risk is essentially zero, and you can go ahead and use another 4% of your account to buy another block of stocks, and then change your trailing stop loss order to reflect the increased number of shares you have now. So again, you're never risking more than 1% of your portfolio at any one time, but the higher the stock goes, and if it really is going to the moon like you predicted, then eventually you'll buy more and more of that stock as it goes up, and repeat until stopped out. So next system is your own sector server system. By now, several of you probably have either a free sector server account or you're subscribing to sector server accounts. Either way, sector server comes with a free strategy that you can either use or just follow along. Remember, sector server is improvement on classical pie chart investing if structured correctly. And here's what I mean. Sector server has two main tools. It has something called Storm Guard Armor, which helps to differentiate between when it's relatively safe to be in stock market and dangerous to be in stock market. And then it has a sector rotation component where it can optimize trends, choose the trend leader during the safety portion of the markets or the dangerous portion of the markets. So if we were to split up our funds so that we only rotate through stock funds during when it's relatively safe to be in the markets, and then rotate only through something like bond funds when it's dangerous to be in the stock markets, and use Storm Guard Armor to differentiate between the two, that's how we can build our sector server strategies. Now, when you set up your sector server strategy, if it's set up properly, you will get signals every so often through either email or text or both, depending on how you set it up. Now, my experience is, at least for me, these signals are fairly reliable. However, because I monitor several people's accounts as a professional, I log on periodically just to make sure I'm not missing any signals. So for this month's free strategy, number one, it still remained in the safe for stocks zone. However, there is a trade alert. So here's what's going on. So here's the example free strategy. It's using a different flavor of StormGuard Acute Quick Response. These are the combination of stock and bond funds that it's rotating through. And it's going to cash when it's dangerous to be in stocks. And here we have a trade alert. So when you have a trade alert, you log into sector server and you look up what's going on. So for this date, it says sell this fund, buy the Fidelity Worldwide fund. Once you make that trade, you log back in, you see this big red acknowledge button, you click on it. And then that turns into a big green done button with the date that you did it. Now sector server will leave you alone until the next signal. And if you take a look, this particular strategy trades approximately 5 times per year. So in summary, this month we covered whatever gets measured gets managed. That goes for anything you want to manage, whether or not you want to lose weight, whether or not you're managing patient's conditions, whether or not you manage your own critical capital mass or your own debt. Whatever you measure gets managed. Then we went over our systems, including our 20-month moving average system, the monthly rotation investment system, how to deal with stock tips using the 25% trailing stop loss system, and finally reviewed our free sector server strategy. This month we have a trade alert. So keep those questions coming. I know I talk to several of you personally every month and realize that for some of you, these video updates are not enough, especially if you're still unhappy with your current investment strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup and breakthrough session. This is a situation where it's just you and me. Ask all the questions you want, no matter how simple you think those questions are. And together we'll work through creating a sense of clarity about the financial future that you really want. Once you get there, we'll discuss which building blocks may work for your particular situation. I know I go through a lot of material in my book and in my videos, and we'll figure out, just you and me, which ones may work in your particular situation. After that, we'll determine what has stopped you from having the investment results that you want, and then identify possible actions that you can take that may move you towards the financial goals that you really desire. Finally, we'll finish the consultation with the excitement of knowing exactly what to do next to create the financial future that you really want. Think CME, only the topic is financial and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.